My name is Drew Leahy. I am the managing partner of Hawk Ventures. I was invited here today to moderate a super cool panel about basically about financing startups. What's the difference between non-dilutive financing and financing? I've been an entrepreneur the last 15 years. I've been a venture investor the last 5. Partnered recently with David Chan and Eric and Tony from Hawk Media to launch Hawk Capital, which is a non-dilutive financing option. We have some amazing people on our panel here today. We have Hamid Hussein, the president of Bank of California. We also have Brent Murray, who's a principal at M13 Ventures in Los Angeles. Guys, we're going to chop it up here today, make finance a little interesting for the group, and talk a little bit about what financing looks like for your business. What are some of the options available to you? And what are the differences? Because it can be a little confusing for entrepreneurs who are just starting out. Maybe they have a local business, maybe they have a digital business, maybe they just started a software company, or maybe you're thinking about starting a business, but you haven't quite figured out, where am I going to get the money from to grow this thing? So, the first thing is that the biggest challenge for businesses is working capital to fund the growing business that you have. There's dilutive capital, which is what I would consider an angel investment, a venture capital investment, an accelerator that's coming in and giving you money and teaching you how to grow your business. And then there's non-dilutive capital options, which is a bank or a loan or merchant cash advance, or an MCA, which is what you see Hawk Capital runs. That's what you see a lot of these other sort of financing solutions in the space, where they look at your data and they say, we're going to give you a little bit of cash, and then we're going to take a little bit out of your sales every single day, which is why it's a cash advance and not exactly debt. But the difference between dilutive and non-dilutive financing at its core is that non-dilutive financing does not take a portion of your business. It doesn't buy stock. It doesn't buy equity. And so that's why the options are a little bit different, and why you should weigh them out as you think about your business. So, gentlemen, I wanted to open up this first question to the group. So when considering a funding provider, what are the key features and offerings that an e-commerce business should be looking for? And I'm opening this up to the group, so go ahead and take it away.
I can go ahead and start. I think how quickly funds can be deployed is really important, because are you looking for funding immediately within a few days, or can you wait a few months? For example, like an IPO, that's going to take a while. If you're looking for an angel investor, you have to go around and pitch. But if you're looking for something within a few days, you can work with revenue-based financing. Next, I would say like the offering loan amount. If you're looking for $1 million, but you're only being offered 50,000, probably not the right choice, right? Repayment terms, obviously. You want to make sure that it's something that can actually fit within your model. Is it going to break the bank? Are you actually still going to be profitable by taking that loan and still repaying it? I'm not going to take everything away. Hamid, Brent?
Sure, I'll chime in. On traditional banking, it's probably not the first option to go to, because a lot of bankers are not going to do startup financing unless you're deeply backed and you've got good sponsor equity. Banks are traditionally going to look for some form of collateral, some form of backing, or, as David said, if you've got a history of a revenue stream, they could lend on your revenues, and then that would be some form of asset-backed type of lending. But traditionally, if you're going to go to a bank, you want to make sure that you're talking to a bank that has a good understanding of what your business model is, where you're going to go, what type of technology they have, that they can understand what you're doing. If you walk into one of the larger money center banks, you may get a different reaction than if you walked into a community bank. You want to be certain that you're talking to someone who's going to spend the time to understand what you're trying to get at and where you're going. I think that's the biggest key, and then have a good business plan, right, as well, to present to a bank when you're going to approach a bank for financing. But normally banks look for a lot of depth of collateral or guarantor support. There is other ways to get financing from banks. If you're going to have a lot of hardware, you can get leasing potentially. Some banks will also lend on IP. But normally you want to make sure that you've got some depth before you approach a bank for financing.
Thanks, guys.
You want me to jump in with the expensive piece, the equity piece?
Yes, I was hoping you would jump in on this part.
That's right. No, yeah, happy to fill in. So I just jotted down 4 things that I was thinking of that came to mind, and these aren't all exhaustive list of the only 4 things, but just things that I consider. Before I jump into the 4, the high level is if you are resorting to equity and you decide, I want equity on my cap table right now, just cast your net wide, right? It's always competitive to get financing. And so, don't go after 1 or 2 people that fit these 4 things that I'm going to talk about, but cast your net wide. And then, as you start
real quick, what is a cap table? Is that where you put your hats and show them off to your friends?
That is one type of cap table. The cap table I was referring to is basically the ownership of your company. So it's called a capitalization table, or how the capital is allocated in your company. And that's how shares are distributed. When you start getting equity financing, oftentimes founders, original people, will have common shares, and equity investors that come in later will have preferred shares. We can dive into a lot of that later, but that's basically what you take on in your first round of capital, either friends or family round or seed round of capital. So really quickly, the first, or those 4 things that came to mind were, first is experience, right? Do they have, if you're looking at equity financing, do they have other brands, other DSC companies that have performed well, that have done well? And I think there is a caveat to that. What did well 5-10 years ago might not do well in today's environment. Like Warby Parker had a fantastic IPO today. I bet the seed investors that invested in them, 5, 7, 8 years ago, they're not the same tactics that are used today to grow your business. And so experience is great. Recent experience is better. And then the second one is resources, right? How are you going to grow after you receive the equity check? What are the unfair partnerships advantages that equity investor is bringing to the table between retail relationships, online agency relationships? That's one thing. I think third is, who is the actual individual? It's not just getting an investment from a venture firm, but who is the partner lead on that deal? What have they done? Can you trust them? And I think the last thing is brand vision, right? Oftentimes we back, brands with a story, a vision, a purpose, and do the investors align with that? I think those are things to consider when taking equity, because they're a long-term partner. A bank you can pay off, be done with them. Equity, we're in it for the long run, for good or for bad.
A little bit like marriage versus going on a couple first dates, right? There's a big difference. And then I want to jump into question 2, Brent, back to you, since we just heard about equity financing. Can you briefly explain how your respective financing model, and we're going to go to David and Hamid as well, explain how your respective financing model works and how it differs from other forms of funding? You covered some of this, but maybe you could do another high level of your model and how it differs from other funding.
Yeah, of course. So equity, there are multiple forms of equity, right? You can take very, very quick and easy, simple equity, all the way up to very complicated structure equity. And the way it typically works is, the first time you take equity, it's a very simple structure. And as you get later and later in stages, it becomes more and more difficult because investors put more things in there to protect their downside. But equity, the first form of equity is usually come in the form of, it's called a SAFE agreement. It's an acronym, SAFE, which it basically stands for Simple Agreement for Future Equity. Simple Agreement, Future Equity. And it kind of acts as a convertible note. They don't own equity, investors don't own equity yet, but the agreement is a standard template that has been prepared by an accelerator called Y Combinator. And it's very simple. It basically says, I'm going to give you this much money, And at some point down the road, when you raise a proper round of equity financing, it will convert into X amount of ownership. And so it's a very simple structure. Most lawyers can do it very, very quickly. Then, you can structure a actual preferred equity round where it's much more complicated. You usually pay 20, 30 grand to a lawyer to get it done. But it puts a little bit more structure in place. And so, when you think about equity, equity is more expensive. You often hear that, right? Because you're giving up ownership in your company, right? So I think that's the key piece. You're going to have a long-term partner, it can be a good thing. They can help you with resources down the road, but you need to understand that if you own 100% of your business, after you receive an equity financing, you might only have 80% or 70% or 90%, depending on where it is. So you're giving up a piece of your company, which if you end up selling it for $100 million, that's really, really expensive equity, or it's really an expensive form of financing. Now, if it gets you to that 100, I would much rather have 70% of 100 than 100% of zero. So you need to think about that, but that's just kind of the trade-offs that you think about when you're taking equity early on.
No, it's perfect. Let's go back the other way. Hamid, what are some of the ways that your financing model differs? And tell us a little bit about how the bank model works. Some people still don't really quite understand how banking works.
Yeah, so the exact opposite of what Brent just said. Bank financing is probably the cheapest form of financing you can get, but it is the hardest form of financing you can get. It takes a long time, and there's multiple reasons for this. Obviously, the form of repayment for a bank is not an event in the future, a sale or whatever, disposition of assets or of the company. It is via cash flows, right? So when you think about borrowing from a bank, what do they look at? They look at what is the cash flow for the repayment of their loan. They will do loans, but they want to make sure that you're performing, if you're pre-profit, what other forms of collateral can you put up? Do you have pretty steady revenues? Do you have a growing business? That's what they're going to look at. Bank of California, that's what we look at. We look at, how much experience do you have? What is the business model? We try to spend time as much as we can to understand that business. Our repayment is not going to be an event-driven repayment. It is purely from cash flows. And so then it becomes harder. But if you have a good business plan, if you've got a banker who will sit with you to try to understand that, you can try to get bank financing. Bank financing is not going to be something, that you should walk into a bank day one and ask, unless you've got a significant sponsor or something else that you can offer the bank. But if you are able to get bank financing, it is significantly cheaper than what Brent mentioned, taking equity, and you're not going to dilute your ownership in your company.
We won't even get into covenants or what happens when you break those covenants and they call the loan. All that could be pretty crazy. Also, why experience is so important getting a bank loan, because there's some crazy things that happen if things don't go your way. David, tell us a little bit about merchant cash advance, and tell us a little bit about how your financing is structured and how it's different.
Sure. So the easiest way of thinking about revenue-based financing is paying for today's costs with tomorrow's revenue. It's an alternative lending option that generates offers based on your historical performance. And then the loans are repaid using a percentage of your sales for your revenue. So once you go ahead and connect your sales and marketing platforms like your Google Analytics, your Shopify, WooCommerce, Facebook, Google Ads, an algorithm will go ahead and generate multiple offers for you to choose from. And this is done within a few hours. If you connected your data right now, you can go ahead and see those offers within 3 hours or so. I would say it's probably one of your greatest options to go ahead and front your inventory costs or your ad spend. Because with inventory costs, you have the classic 30-70 split where you have to pay 30% upfront to your supplier. You wait however long, 1 month, 2 months. And then once you get the product, that's when you have to go ahead and pay the rest 70%. However, that can be really crippling for a business that relies on that cash flow. To pay 30% upfront and not have any inventory, you're going to struggle a bit with that. For ad spend, on the Hawk Media side, we see businesses that are running ads, they figured out the targeting, they know what the messaging is, but even though they put all of the profit back into their ad spend, they're not scaling at the rate that they could. So that's where we can come into the picture with revenue-based financing and really just go ahead and help them compete in the space by offering them a much larger budget so that they can go ahead and scale much faster. In terms of differences, I know we mentioned it before, but I would say it's unsecured, no collateral compared to like traditional bank loans, and non-diluted. So you would retain complete ownership compared to like a VC fund where they might take up to 20%, I would say. I think it's going to be around 20%. And that's going to be really expensive for your business because like Brent said, if you think about 20% right now, maybe you're only making 10,000, right? That's not much. Once you scale your business to 100,000, that's going to be a lot.
Thanks, David. And the other thing to note is with merchant cash advances, they're actually kind of going into your cash flow daily and taking it right off the top. It goes right into the bank account. You don't even see it. You don't even have to pay a bill, right?
Correct.
So
it's just an ACH pull from your bank account.
So in some instances, you could almost think about it as like margin of your product, right? So if your product costs X and your gross margin is Y, and you have X amount of profit left over, and some of that's getting taken out, then it's just basically reducing your daily profit, right?
In a way, you can think of it like that, but I would say really like if you make money, that's when we actually take some money, that percentage, whatever that agreed upon rate was. But the great thing is that if you don't make any sales, we're not taking anything that day.
But that's bad for everyone. That's the good news. So the next question lists some pros and cons of your respective financing model. Does anyone want us to sort of talk a little bit about what the pros are of working with your financial model?
Yeah, I'll just jump in. So a lot of this we've summarized, right? But the pros are if you partner with the right partner for equity, I'm talking the equity piece. The pros are you get experience with somebody that's been there in the trenches, done it before. And you might get really unfair resources that your competitor might not have, right? That relationship with a buyer at Target or a whiz on Amazon, or a multitude of resources that you do in your diligence when you're looking at your equity funder, those resources they have. So that's something you get somebody in your bullpen with you. I think another pro is sometimes it gives like a nod of approval. It's a signal to the market, right? If you get a really good equity investor in, you can do a press release, you can say they're backing you, you can get some virality going there. And then I think Drew mentioned that word covenants, right? Like when you're doing a very, very simple equity agreement, it comes without covenants. You can, like, we give you 500K and you're going to do with that what you want to, right? Whereas a bank sometimes will have a requirement that you stay within some bounds, right? And so it's not just your capital, it's lended to you that you have to pay back. So those are the pros. And then I think the cons are, we've talked about it's the most expensive thing you can do. And so, I wouldn't give away 90% of my business, maybe 10% if I think it could, get me to that next level. So that's something. And then sometimes, as you get in more rounds and you raise a Series A and a Series B and a Series C, more people added to your board, over time, now you have more investors than, maybe your board members, you have to report to people. So that can be great, right? Because you can have experience around the table, but it can also be cumbersome. And so I think you just have to take in, some of the pros and cons about each of those things for equity, that is.
Yep. And then Howard, do you want to speak briefly to
Sure.
pros and cons?
Yeah. So, with a bank, you are going to get covenants. You've got to perform, but the flip side of that is you're not going to get people telling you how to run your business.
Yes.
So you can run your business how you want to. You just have to meet your objectives or goals that you said you were going to with the bank. The thing I would say that's critical when you're ready for bank financing or even choosing a bank to bank at is spending time. I think Brent mentioned this earlier. Look, banking is a commodity business. There are tons of banks. You can walk into any one of them, but you really have to do the research to understand is there a bank out there that's going to spend time with me to learn about my business and what I'm trying to do and accomplish? And are they going to give me that time? So pick a bank that's forward looking. I don't want to plug too much of Bank Account, but
Oh, it's okay.
we pride ourselves on that, on spending time with our clients to try to understand their business and really try to be forward thinking on what's happening in the economy. And look, LA is a big area for tech. And we've got an internal innovation council. We meet every week. We look at companies that are sprouting up, and are there companies that we want to consider partnering with. And we're actually thinking about that, with a couple of folks that are on this line. So I think that's the key, is that, look, bank financing is cheap, but you're going to need to spend time to develop your business plan, understand it. You're going to get a partner, a financing partner, who is just going to hold you to what you said you're going to do. They're not going to tell you how to run your business, and you've got to perform. But you are going to get a good source of financing on a cheap basis.
That's fantastic. Great summary. Before I go to David, everyone that's in the audience, we are going to hold 5 minutes of Q&A. So please write in your chat, write into the chat here, questions that you have for myself or for Brent or for Hamid or David. We'd love to hear from you. So I'll turn back to David to answer the same quickly as Hamid and Brent, but tell us about the pluses and minuses of the revenue-based financing.
Sure. So I'd say keep your risk low. You're not paying money unless you make money. And then there's no collateral or personal guarantees, and putting a collateral is going to be especially hard for a startup. Offers are generated in hours. Once you go ahead and connect your data platforms, you can see it in 3 hours or so. And then once you supply the bank statements, our underwriting team will go ahead and review that. And you can have the funds actually deposited into your account that same day. It's all done online. You don't have to go pitch to anyone. You don't have to drive to somewhere. You don't have to sign the contract in person. Everything's done online, so it's pretty simple to do that. Retaining complete ownership, I think, is really important, especially for a startup, because there's no potential for conflict with any investors, and you really retain all of that decision-making power yourself. I'd say another pro is it's not based on your personal credit. You might have really crap credit, but it's only based on your business's revenue. So if your business is doing well or scaling up, you would be eligible for that. In terms of cons, I would say we might have strict criteria. You need at least 6 months of sales data. You have to obviously be selling something online. We wouldn't work with dropshipping businesses either. I guess the last one would be an emphasis on like immediate revenue, right? So I've spoken to brands that say, hey, we're going to have a large marketing campaign next year. We're going to have this launch of this new product, whatever it is. Like, we're only looking at the revenue, your historical data. So even though you say you have a launch, like, we might have to wait until after to actually go ahead and provide you with funding.
Fantastic. So we have a message from the audience, and I'll give this to all of you guys, but I think probably more directed at Hamid. How do you see the landscape changing as banks change in the US with everything going on in the market with banks? How do you see the landscape changing?
Yeah, good question. Fintech has been a huge disruptor, right? It's disintermediated lending, branch banking, everything. And as more and more fintechs come online, I think that's going to continue to have an impact on banking. We've invested with some fintechs. That's going to be critical, is really just, and sort of what David said as well, is moving to that online platform, making it easier for people. That way you're not coming into a branch or to a bank to meet with somebody. I think that's going to be the way of the future. You're going to see less branches. You're going to be seeing less locations. All the big banks have cut back on their number of locations. Again, just coming back to, I think banks also have to get smarter and wiser about how they're looking at this technology space, right? 20 plus years ago, I was a corporate tech banker, and we were trying to lend money to the Intels and the Ciscos of the world when they were a lot smaller. And I'm sure there's a lot of those companies, potential companies on this panel or on this forum, but really banks have to be more open-minded. I think that's got to change. And you're seeing more of that from the community banking space, maybe less so from the big money center banks, but I know all of them are looking at that. When you hear about Jamie Dimon talking about crypto, that's also going to be an influence going forward with all the banks.
Great. We have another question from Patty in the audience. What's the best option for a brand coming up to Black Friday? It's just around the corner. We got Thanksgiving sales, people buying. Americans love this. The world as well loves the Black Friday, Cyber Monday sales. What's the best option for a brand coming up to Black Friday?
I would say you're maybe a little bit late for marketing your campaigns for that. You should have started maybe like last month or 2 months ago. But considering that you're in a time crunch, I would say revenue-based financing might be your quick option because you can go ahead and get the funding immediately. If you did it right
Brent's
now,
not just gonna open up the coffers for the venture fund just to help Cyber Monday. Oh, come on.
I mean, I would love that. I would probably advise against that, right? Like what I've seen, it's been cool to just take a step back over the last couple of years and just see the change and the uplift in new forms of financing that aren't like dilutive for gut reactionary funding purchases, you know, like just funding something for Black Friday to get the sales. That's obviously important. But nowadays there are tools like Hot Capital that enable you to not, you know, give away 5% of your company just to have a good Black Friday. So, you know, I think those types of funding solutions, you can certainly get a safe done, like one of those very, very simple equity agreements in a couple weeks. I mean, that's not a problem, but I would advise against giving away your company just to fund, you know, a marketing expense or a product order. What we actually, you know, M13, if you look over the history of our fund, 5, 6, 7 years ago, we invested in a ton of brands. That was, you know, when we were investing in the D2C brands. As we've now evolved as a firm, we're investing in a lot of these non-dilutive financing options. We're kind of going down the technology stack and investing in enablement tools and software services. And so Hot Capital is one. There are other options. One that we just funded is called Upside Financing. And while David and his team help you with your online sales and they can, you know, judge what you've done over the last 6 months, Upside is more for CPG brands that have a bulk of their sales offline, right?
That's
so it's helping you fund product orders, and it's a non-dilutive form of financing so that you do that, you know, if you have a lot of just stuff on the shelves at Whole Foods or similar, you know, retail.
Fantastic. I think we're out of time. We had one quick question that I will answer from Matthew. Do you see one model as being the future or will it remain scattered? I think the future is always horizontal. It's being smart. It's taking a little bit of this and a little bit of that. It's understanding when timing is right for your particular financing model. Sometimes earlier equity is better, later banking is better, somewhere in the middle. The revenue-based financing can be really helpful to get you to a place where I can go and take a bank loan because I have a repeatable business model. I believe we're going to continue to have innovation across the space, get more and more niche, get smarter and smarter about what types of financing options are best for which types of companies. We're just going to keep widening the bottom of the pyramid, I think.